please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We are carrying forward this theme of resolution of stressed assets and what is their impact on corporate banks, especially public sector banks. Karthik Srinivasan, the Group Head Financial Sector Ratings at ICRA, and Krishnan, the Banking and Financial Analyst at SBI Cap Securities, are joining us. Gentlemen, thank you very much for joining us. Well, first up, let me get to Karthik. Karthik, what is your sense about the likely provision number for public sector banks this year and likely losses? Because last year as well, I think they reported over 1 lakh crore in terms of losses.
I think from a banking sector point of view, specifically for public sector banks, we expect a lot of them to report losses for the current financial year as well. The exact quantum would depend on a couple of things. One is how much of resolutions happen during the year and how much at significantly lower haircuts than what one has provided. So at a broader range, last year we did see a net losses of about 1.3 lakh crore for the public sector banks. This year, the band would actually be quite wide depending on how the resolutions pan out. But I guess it should be at least...
Go ahead.
You should see 75,000-80,000 odd crores of losses for the whole year. Might be lower in case the resolution picks up.
Okay. Karthik, hi, morning. In your report, you have written that recoveries and upgrades, the increase is supported by the NCLT resolution, or at least of 2 steel accounts for the industry as a whole. But do you think this trend will sustain? Because now we're expecting the haircuts to be higher than the provision cover in many other NCLT accounts. We just heard the management of BOB also tell us that the haircuts could be as high as about 60-odd%. So do you think this trend in terms of recoveries and upgrades could sustain?
It may not be a serial upward kind of a trend. It all depends on which accounts get settled in which quarter. So Q1 we did see 2 steel accounts that really helped in terms of a higher recoveries as far as Q1 is concerned. Possibly 1 or 2 more steel accounts which could give an upside to the banks. But beyond that, it's really going to be difficult because a lot of the power sector assets, there could be higher haircuts, or the kind of upgrades that the quantum of upgrades that one saw in Q1 might need to get moderated.
Okay, the problem really will be capital. If you keep on having to provide and you're not getting write-ins from the resolved assets, you will be short on capital, right? What you have said is that 9 PSBs reported Tier 1 capital ratio lower than 7.5% as on June 30th. The minimum obviously is 7%, so 9 of them have only 7.5%. Do you think these 9 would be the guys who won't be able to grow?
Yeah, to a large extent, yes. If you really look at the PSB space, you have 11 of them in PCA. And effectively means most of them are running short on capital. Our own assessment is the 11 banks which are under PCA, in all likelihood would see a 5 to 10% degrowth as far as risk-weighted assets are concerned. So that's our baseline assessment. The only instance where they can grow is in case the government increases the allocation of capital to these banks. Given the current market situations, we're not very hopeful that they would be in a position to raise it from the non-government sources, at least as of now.
Okay. Krishnan is also
I want Krishnan to put names, since Karthik will not give us names. Krishnan, which are the public sector banks that can grow? As Karthik says, 9 of them don't have the capital unless government increases. And this year the government has other priorities. It has Ayushman Bharat, it has MSP. So I don't know whether they'll have money for bank capital. Which are the ones that can grow?
So I think that list of investable PSU banks which have growth capital would anyways be restricted to maybe 4, 5, 6 names.
So it would be what? SBI, BOB?
SBI, BOB, Indian Bank, Vijaya Bank, I believe, Canara Bank. So there are obviously larger banks which are where as Karthik mentioned, if the timing of recoveries from the NCLT, if the resolutions from NCLT If you get lucky with the timing, then chances are you have growth capital on a recurring basis. Otherwise, you will need to moderate or recalibrate your growth expectations vis-a-vis where you stand as far as growth. But yeah, these are probably the investable universe within the PSU banks, given there are quite a few banks that are distracted and disturbed right now. Yeah.
So do you see in general the resolution of the stressed assets drive a decline in the gross NPAs, net NPAs for the banking sector over the next couple of quarters?
Quarters is difficult. I would think by the end of the year you should see resolutions for sure. You should see meaningful, increase or improvement in resolution environment for sure, and that should then, reduce your gross NPAs because your debtor is now moving from a weak hand to a stronger hand. So ideally, that should come with there is a single check being paid out, etc. So your gross NPAs do tend to trend lower then.
Okay. Yeah. Krishnan, Papia Sengupta was saying, the BOB ED was saying that about 60% write-off or haircut. Wasn't that optimistic?
We are a bit more optimistic than that on the power sector. But as I said, as we have said...
I'm looking at the entire average. Okay,
so
for some specific cases, you are expecting better than that.
So
better than 60%, you expect only 50% write-off.
So, Lata, the thing there is whether you're looking at principal plus capitalized interest or whether you're looking at principal plus capitalized plus accrued interest.
Okay.
Right? So, the bidders are looking at only principal component. They clearly aren't worried too much about what is the capitalized interest, etc. So I think that's how the resolution processes tend to go across the world. That's how it will be in India as well.
Yes.
It's essentially what's gone into the construction of the project, which will essentially be what the bidder is looking at, not the capitalized interest, what is under construction. That may all go for a toss. So on principle, will you be able to get a fair bit? I would think yes. If you have loaded a lot of capitalized interest and accrued interest before recognizing as NPA, then very clearly the haircuts will be steeper in such assets where there is a significant load factor.
Okay. Karthik, can you just give us the numbers? I mean, how much do you expect by way of resolutions over the next, say, 12 to 18 months? What kind of recoveries are we looking at for the industry as a whole? And how much do you think the slippages could moderate to as a percentage of advances over the next 2 years?
If you look at slippages, Q1, Q1 the slippages have come down quite sharply. It still remains high at about 4.7% on an annualized basis, which is better than last year of 8 and 7 in the previous year. Our estimate is with bulk of the recognition of NPAs and stress assets having been done, we believe by the end of this year we should be at a run rate of about 3% of NPA generation. And then hopefully should things stabilize, should probably hover around 2.5 to 3% going ahead. In terms of resolutions on these stressed accounts, pricing would really be the key. On one hand, we've had RBI prod banks to at least increase the provision on these assets. So to that extent, it makes it easier for the banks to take a decision. But finally, there are a lot of chunky assets, and the actual quantum of resolution would depend on which of these chunky assets gets resolved or gets taken to NCLT. Our own estimate, if we were to look from the February 12 circular point of view, most of these accounts are already classified as NPAs. Our estimate says that almost 85–90% of the so-called list would anyway have been in the NPA bucket, and most of these would have come into NPA over the last year and a half. So banks would have any case provided anywhere between 25 to 35% depending on the gestation period with the particular bank. So if you work with, let's say on an average of 50 to 60% kind of a haircut which would be required at a portfolio level, some assets could be less, some assets could be more, but at a portfolio level you're talking of another about 20% of provision to be done by the system. So very roughly you can say about another 50–60,000 crores of provisions possibly needs to be done. But yes, the actual quantum would depend on what is the haircut that finally comes about, and what sort of resolutions happen on the other accounts which are already at various stages of NCLT and resolution. So any improvement on the recoveries from the earlier accounts could lessen the burden as far as the banks are concerned on a going forward basis.
Well, let's see, we have to accept one point. There's no point talking about provisions because all these are already recognized NPAs and they are provided. All we want to know is haircut. And I've got two numbers over here. There is a Nomura report which says they expect higher than 75% haircut. And there is a Deutsche Bank report which says that they expect just about 10 to 20% recovery from the power plants referred to NCLT. If that is that you're working as well? I mean, from this, 40 assets that will go power plants, maximum Nomura gives is they will get 25%. DB says they will get only 20%.
So, I mean, in either of those reports, I think there is a distinction you have to make as to how much is being referred to NCLT. There is also resolution happening outside NCLT.
4 or 5, no, yaar.
So there's about 9 gigawatt, which is probably already resolved, right? So there is 8.8 gigawatt that's already resolved.
Yes,
there is another 10 to 12 gigawatt, which is probably likely to be resolved or very close to resolution, right? So the way we look at it purely from a capacity perspective, we are looking at about 50-55% of that 40 gigawatt stranded capacity will get resolved. 45% will go towards NCLT. You will have haircuts in NCLT, right?
Okay.
And purely from a bank's exposure perspective, that 2 trillion, 1.8 to 2 trillion, we think that number is closer to 58% that gets resolved and 42% that goes towards NCLT.
Okay, so this is the main takeaway from this discussion, that for that 55% of the power companies, probably the haircut will be only 60%.
See, right now these haircuts are based on fundamentals, right? So that's how we tend to work. Point is, it will depend. So right now we are in a bidder's market. If you push too many assets into NCLT, we remain in a buyer's market. There are very few takers, too many assets. So very clearly discovery will be in favor of the buyers. But I think referral to NCLT versus admission and actual resolution is an 18-month process. And I think by then it moves towards more fundamental demand-supply driven market. And that's where we are hopeful.
Okay, well, thank you very much.
Leave it at that.
I can just get this much in terms of numbers for if 45% of the cases are referred to NCLT, there the recovery is only 20 or 25%. That is at least one clear takeaway.